Hi, welcome to another Steadyhand update. Today we're talking all things inflation, and we've got the perfect guest to do that with. With me is Carolyn Kwan. Carolyn has been a senior economist at Merrill Lynch, Scotiabank, and she even spent many years working at the Bank of Canada. Today she's a portfolio manager at Connor Clark and Lunn, who manage our income fund, which, as a reminder, is comprised of 75% fixed income and 25% dividend stocks. So investments that are very much impacted by inflation, and a guest who knows a lot about inflation. Thanks for doing this, Carolyn.
Thank you. It's my pleasure.
So let's just talk about inflation broadly speaking before we get into the outlook or the positioning, some of the more general comments about inflation. Now, it feels like it's everywhere, or is it something that we're all imagining? Is it bearing out in some of the numbers that you're seeing?
I think it's in fact that the data are bearing out that inflation has become a pretty major factor lately. So if you look at the Canadian Consumer Price Index, which tracks Canadians what we pay overall over time, it has been rising quite significantly. So for the full year of 2021, CPI hit 3.4%. And this is the fastest pace of inflation we've seen for the year as a whole in over 30 years, really since 1991. And it was in fact accelerating into last year. If you sort of think about our latest couple of data points, we've in fact had our year-over-year increase in CPI grow to above 5% now. We're at 5.1% January of 2022 compared to January of last year. So to start this year, inflation is in fact looking like it will stay high for a little while.
So when you look at that CPI number, or broadly speaking, the inflation number, maybe take us into what components make up that number. What is the Bank of Canada looking at when they're calculating those what seem to be record-setting numbers these days?
Yeah. Well, the Bank of Canada would look at a number of different ways of considering inflation. One of the simplest ways is really to take out some of the more volatile components, things like food or energy or airfares, things that move along with, say, commodity prices. And even from that perspective, there are different ways of calculating core inflation. The Bank of Canada uses three specific ways, and looking at an average of those three, even they have gone up to about 3.2%. And that does sound a little bit tamer, but in fact, 3.2% is still above what the Bank of Canada targets, which is somewhere in the range of 1 to 3%. So that's kind of one way to do it. Another way is to think about the components in sort of the way that we would as consumers, breaking it down between, say, goods inflation and services inflation. Goods are all the things that we buy: televisions and cars and laptops, clothing, food, and services inflation, things like getting your hair cut or taking a trip somewhere or going to a restaurant. And so far, all of the inflation that we've been seeing over the last little while has really been concentrated in goods inflation. In other words, it's those things that we've been buying that have been in such short demand. I'm sure we've all been experiencing these messages that say there have been delays in shipping. So, there are really a lot of different ways to break it down. There are, in fact, some 40 something type of subcomponents of inflation, and so those are just a couple of the ways.
And so, when I go to the grocery store, I'm convinced that the $4.99 that I spend on a box of cereal that used to be, let's say, 700 grams is now 650 grams. Is that something that's captured into inflation as well?
It absolutely is, yes. That is a little bit of a different way of inflating the price of something. Typically the most direct way is just to increase the dollar value of something that a company charges. But another way to do it, in fact, is to keep the price the same and to reduce the amount that you get for it. But that is also, in its purest form, a type of inflation, and absolutely that is something that is captured in our inflation data as well.
So we talk about the Bank of Canada targeting 1 to 3%. But I guess it begs the question, why target inflation at all? Like, why is it good for us to have inflation in the system? I mean, I would love not to pay more for things over time than I do today, but it is the target of the bank to keep prices increasing over time.
Yeah, that's right. I think the Bank of Canada believes that the keeping inflation low and stable and predictable is really the best contribution that they can make to the economy, to a well-functioning economy. When you have high inflation, we all know that it does lead to a misunderstanding of the way things actually are functioning in this world. It almost is a layer of fog when you're trying to operate a business. You're not really sure whether your prices or your costs and what's happening with them over time. But of course, it is also quite difficult to target something that's zero. So you'll think, you recall back to our conversation about CPI, there are a lot of different components to it. If you were to target an inflation rate for the economy as a whole at 0%, what you are effectively having at that point is some prices rising and some prices declining. And having decreasing prices year over year actually is something that is quite difficult for an economy to handle, just as high inflation is. And that's because it actually impacts people's decision to buy things, to spend, to invest. If you were to be told with certainty that the price of something you wanted to buy today is going to be 10% lower next year, you might think twice about buying it today. So there's an important sort of level, I think, that's above zero, but still relatively low in terms of trying to control inflation that is really optimal. And so the Bank of Canada is targeted somewhere between 1% and 3%.
1 to 3% is kind of like this Goldilocks type of scenario where it's not so high that it makes us all fret and nervous, and it's also not so low that businesses and consumers would wait to buy stuff or invest in capital or whatever it might be that they're doing. Okay, so let's switch gears to the outlook now. What is Connor Clark and Lunn's outlook right now? I guess, how long do you think inflation is going to last?
Yeah, well, inflation, as we all know, has in fact become more and more topical because it has been rising over the past couple of months. And our view is that inflation is going to stay high for the near term, for the next few months, but that it really should start to peak and start to come back down again towards the end of this year. And we believe this is the case because part of what we're seeing right now is a response to very strong demand, but difficulties in supply chains. And we think it will take time for those supply chains to work their way through, but that it should happen sometime later on this year as the economy normalizes, as movement normalizes, as all of these lockdowns that we've been all experiencing sort of come to the end. And people's spending will also normalize. We'll all start to do a little bit more going out and spending money outside. And so as all of these factors normalize to some degree, we should see inflation peak and start to come back down again. But we think somewhere in the upper end or the upper range of the Bank of Canada's target, somewhere around 2 to 3%, maybe even slightly higher than that. And that's because we have, in fact, been in an environment now lately where we are seeing commodity prices fairly high and stay that way. So that is one of the sources of upward price pressures we see being sustained a little bit longer than we had originally thought.
And so let's just clarify. So what do you mean when you say, are there certain commodities specifically that you expect to continue, or are you're talking generally about what we're paying at the pump right now?
No, I think it's going to be specific to certain types of commodities. You've suggested energy, and that is absolutely one of those very important commodities. We've of course been in an environment where the price of crude oil, price of natural gas, they've both been quite high. So we've all experienced periods now where the cost of heating our homes, the cost of filling up our tanks and our cars are all rising. Energy prices are certainly one of those commodities. The other one is food prices. Food prices is also one that has been rising from a commodity perspective. If you were to look at all aspects of the food supply chain, they have all been experiencing upward price pressures, meat prices, grains, but in addition, even things like fertilizer that are going into production, these are all seeing quite significant upside.
And we are seeing some, a major crisis happen in Europe with Russia invading Ukraine and a war going on there. Both those countries have an impact on the world in terms of those commodity prices that you're referring to. Are there certain things there that are impacting inflation potentially?
Yes, absolutely. I mean, I think there, in addition to all the difficulties and the the problems associated with that on a human level, the sort of direct linkages that you can think of towards an economy are really through the commodity price channel. Russia themselves are a very large exporter of some of these commodities, notably energy and food food commodities. And so this war is in fact going to reduce the supply of energy commodities and push the prices up. The most direct effects of these, these limits in exports are going to be felt in their largest export markets, which is the European Union. The European Union gets 40% of its natural gas and 25% of its oil from Russia, and is dependent on that to continue to maintain its their industrial production. So these are going to influence, prices in Europe, but it's also going to influence prices globally, because commodities really are in fact a global commodity. So we will also feel the difficulties here. In addition to energy commodities, Russia is also interestingly a major wheat exporter. They account for, in conjunction with the Ukraine together, about a quarter of the world's wheat exports. So again, supply constraints are likely to come, and that will influence prices upward.
That's a really interesting point. I mean, we hear a lot about the commodity angle, but less about the food, the wheat angle from Russia and Ukraine. Let's switch gears now and just talk about your positioning. What are you doing with this outlook in mind in the portfolio? And we'll start with the fixed income, the bond part of the portfolio first.
Yeah, well, one of the things that we typically do at this part of the economic cycle, we've been through a fairly deep recession. We're in the early to mid stages of the economic cycle, is that we would be owning higher yielding bonds. So bonds that, for example, are issued by provinces or issued by corporations. But it's interesting, at this point in the cycle, we have actually seen the value of these bonds actually rise quite significantly. Just like we've actually seen the value of stocks. Everybody's aware the stock market has risen as well. So in fact, what we've been doing most recently over the past 6 months of the last year is that we've been trimming owning some of these higher yielding bonds and owning more Canada bonds. What's been notable over the past couple of weeks is, as we've started to see some of that volatility pick up in equity markets, we've also seen that translate into corporate and provincial bonds. And as they've become better valued, we've actually been stepping in to buy some more and add to our positions of provincial and corporate bonds to some of that additional yield at better prices.
Now, are you doing anything more targeted? I recall that there was a point where the fund held some in real return bonds. Is that still the case? And if that is, maybe just give a quick explanation of what a real return bond is.
Yeah, absolutely. Real return bonds are bonds typically issued by the Government of Canada, but also can be issued by provinces. And they have a yield, just like a Government of Canada bond does, but they also get on top of that the CPI index. So in other words, as inflation rises, the value of these bonds actually does better. And so these typically work in a bond portfolio as a good hedge against inflation. And what's been interesting is that through this period, we've actually been buying real return bonds into the portfolio. And we've done this now for a couple of years, anticipating, in fact, that the value of these would normalize and do well. Over the last 12 months, they have, in fact, done quite well. And as they've been appreciating in value, the end of last year, we started trimming some of those real return bonds. This early part of this year, we've actually found it very interesting. As the value of these bonds became more interesting, we've actually stepped back in, started to buy some of these real return bonds back again, expecting that they would continue to be a good hedge. What's been notable about the price movements is that the prices actually come down a little bit, and that seems almost counterintuitive. Why would the value of real return bonds go down when inflation is actually rising? We're actually buying some RRBs in the longer end of the yield curve, so owning 10-year or 30-year types of RRBs, and these have in fact been reacting or responding to the more aggressive central bank talk. So that the tougher central banks have gotten on inflation. The bond market is saying through this that they're less likely to see long-term inflation get out of hand. and see these inflation surge in the 30-year, 30 years down the road. So in fact, some of these real return bonds have been declining in value, and we're looking at continuing to add a little bit here and there.
And switching to stocks, these are dividend-paying stocks. How are these impacted by inflation, if at all?
They absolutely are. So for the fund, we, as you say, do own dividend-paying stocks. This can be in the form of companies that pay good dividends. We typically look for a dividend yield above 1.5%. And these companies would pay that dividend and hold them stable. In other words, they don't cut their dividends over time. But there are also other companies that in fact grow their dividends. And so what we've been doing in this most recent period, as inflation has become has risen of late, we've actually been pivoting now to increasing the proportion of companies that have been growing their dividends. So to give you a bit of an sort of historical perspective on this, our positioning breakdown historically is that we would hold about 2/3 of the portfolio in dividend growers versus 1/3 of the portfolio in dividend payers. And we've now tilted that to be even higher, about 80% now of the portfolio is now in dividend growers. Only 20% is in dividend payers that hold their dividends constant. And that shift really is a reflection of the environment we're in, where we believe that we want to see these dividends rise over time just to be able to keep up with inflation.
And so just give us a quick sense of what sectors these more dividend growers would be in.
Yes. Well, the dividend growers are typically those firms that have the ability to grow their earnings in order to generate that cash in order to grow their dividends. And so the universe of these types of companies include those who are in the financial sector, so banks and insurance companies, as an example. The banks typically do better when interest rates are above their zero bound and rising somewhat. So that's one area. Commodity producers is another one. We look for commodity producers that continue to pay dividends and grow them, but their selling prices rise at the same sort of pace or rate as inflation does, and so they continue to generate good cash flow. And then finally, consumer staples is another area. These have been companies like grocery stores. They have been traditionally fairly effective when it comes to maintaining profit margins in aggregate. And so being able to do that allows them to continue to pay out dividends at a good clip.
So if I could summarize the conversation, yes, inflation, it's not just a feeling. Inflation does seem to be pretty pervasive across what we buy and what we're using in terms of services. Your outlook is that you expect inflation to maintain a higher stance, let's say on the higher end of the Bank of Canada's range through much of this time, and as the economic systems adapt to some of these changes that we're experiencing, these supply chain constraints that we're experiencing, and specifically to the portfolio, fixed income, you held some Government of Canada bonds, and you've also been taking some positions in some provincials recently. You've owned real return bonds more recently as well. And in terms of the stock part of the portfolio, you're investing more in dividend growers. You've tilted the portfolio there. Is that all fair to say?
That's exactly right. That's a very good summary. Thanks very much.
Well, thank you, Carolyn. Always enjoyed talking to you, and I know this has been certainly helpful to me, and we hope that it's been helpful to the viewers watching this. Thank you all for watching. If you've enjoyed this content, please subscribe to our YouTube channel, and you'll get notifications when we put up more of these videos and more updates from our investment managers. Thank you all, and until next time.